Welcome to another interesting lecture in the series of lectures we are going to have for taxation at the application level. Now we want to look at estate at the settlement trust estate of a disease. Taxation of settlement trust estate of a disease. Okay. All right, let's move on. An estate trust or settlement is usually set up by either a will or by the order of the court. Did you get that? That is either by a will or the order of a court that will set up an settlement trust estate or estate trust settlement. Now we need to take each of these words one after the other and break them down. Settlement. What do we mean when we say settlement? Okay, what do we mean when we say trust, and what is an estate? What do we mean when we say estate? Now, a settlement is a means by which provision is made for another person, where you set aside money for the benefit of another person. You say you are settling the person. All right. It also means that you can transfer your belongings, an estate or part of it, to another person. Of course, you can do this through a will or through a deed. Are we there? So it has to do with another person called beneficiary. Okay, the beneficiary will be involved that will benefit from a sum of money set aside. Okay, now let's move on to another part of the lecture by looking at what's a trust. What is a trust? What is a trust? Now, in a trust, there's usually a person called or persons called trustees. Trustees. These persons are vested with this power to dispose the property of another person. But they are doing that for the benefit of beneficiary. They will apply whatever comes from the disposition for the benefit of the beneficiary. Okay? In practice, a trust is created when any of this or all of this happen. It is created when one of the beneficiaries, where we have more than one beneficiary of a property, more than one beneficiary of a property, we say a trust can be created. All right. It can also be created where there are members of people, many people jointly owning a property. That's a property belonging to member of people, a group of persons. Or where the beneficiary is an infant. Where the beneficiary is an infant, there is a trust being set up. A trust has been set up or created for benefit of the benefit. It is also interesting to know that a trustee may also be a beneficiary. A trustee may also be a beneficiary. Take note. What is an estate? What do we refer to as estate? In everyday language, an estate to us is an environment where you have many houses that are usually having the same common features. Say you're living in an estate. Now, but here, for the purpose of tax, estate, which is usually created either by a will or by another order of the court, is an aggregate of the things that belongs to a person. They include money, property, and goods of different kind. And if the person dies, or when the person dies, the estate will be passed into the possession of a representative, his personal representative, executor, or administrator. What is the duty of this executor or administrator, he is to meet the necessary funeral expenses of the deceased. Okay, meet the necessary funeral expenses of the deceased, and thereafter he will realize the estate and apply realization to pay debt. There could be debt outstanding before the deceased left Mother Earth. So these bills will be paid up, and legacies also will be paid up. So that is the estate. An estate is made up of the possession of a person that includes money, property, and goods. And on his exit, on the demise of the person, this estate is realized, that is, it is sold, or put it another way, disposed. And the proceed from the disposal is first used to settle his funeral expenses and pay up debt and also legacies. So we take note of funeral expenses from the proceed, funeral expenses, very important, debt, okay, and legacies. We will look at these ones very soon. All right. So the estate realization of estate. Okay. The proceed is used to settle funeral expenses, debt, and legacy. Having said this, let's look at another aspect: administration period. Administration period. The administration period is the period between the date of death and the period that the executor is able to set up a trust. Right? That is, when on the exit of a person, there is an executor who takes over the responsibility of setting up a trust. And we've taken time to explain trust behind. Setting up a trust. The period between the time this trust is set up, it's called administration period. And who are the persons that can benefit from the income of an estate? Let's look at those that can benefit from the income of an estate. We have the following persons. We have the legatee. We have legatee here. Who is a legatee? This is a person who is receiving a specific amount from the estate. He's been bequeathed a specific amount. So, okay, at the end of every month, give this young woman 200,000, or give this young man 100,000. That's a legatee. Okay, and after that we have who? Annuitants. An annuitant. Who is an annuitant? Who is an annuitant? An annuitant is a person who income or receives what we call annuity, and this annuity will be charged on the income of the estate. All right, receives an annuity that's on a yearly basis, receive a certain amount of money on a yearly basis, and this amount is usually charged on the income of the estate. We have the residual legatee. The residual legatee. Who is the residual legatee? It is the person who at the end of the administration period is entitled to an income. At the end of the administration period is entitled to an income. A beneficiary. A beneficiary. Who is a beneficiary? A beneficiary is entitled to an income. Is also entitled to an income. In the case of a beneficiary, he has a limited interest. He has a limited interest. And what it means is that at the end of a specified period, on the death of such a person or beneficiary, the capital asset passes to some other persons. Okay? So that is that about the benefit of those that are involved with estate, those that benefit in one way or the other from the estate of a deceased. basis period. Basis period. The basis period. The basis period. All right. Of estate trust and settlement. What we mean by that is the income accessible in the hands of whoever is assessed on PYB basis. Okay, preceding year basis. Preceding year basis. So PYB. So PYB is what is applied in assessing the income, or that is income that is accessible to tax in the hands of any of these persons, be it the legatee, the beneficiary, the annuitant, or whatever. So PYB, preceding year basis, not on actual year basis. Take note, it is on preceding year basis. Of course, it is after deducting all that should be deducted. It is from the income, and you deduct allowable expenses. After the allowable expenses, what is left is subjected to tax on PYB basis. For capital allowance, what are we looking at here? For capital allowance, let us look at how capital allowance is treated in the case of estate trust and settlement. Of course, we know what capital allowance is when we get to it's the part where we'll be talking about capital. But let me just give you a brief background information about capital allowance. It is an allowance that is granted to a business. In any year of assessment, it incurs qualifying capital expenditure. Qualifying capital expenditure, usually referred to as QCE. It replaces depreciation. In financial accounting, we talk about depreciation, but in taxation, we talk about capital allowance. So, now, where assets are involved, in tax it is called qualifying capital expenditure, but for easy understanding, let me refer to it as assets here. Where asset is involved, capital allowance, capital allowance will also be involved. Now, an asset can be transferred. Okay? An asset can be transferred. Where an asset is transferred to an estate by the individual setting up the trust, the estate. Setting up the trust, sorry. The estate is deemed to have incurred qualifying capital expenditure at a value equal to the tax written down of the asset on the day following the date of the setting up. Are we together? So what this means is, all right, an individual has set up a trust. That individual transferred an asset to that trust. The capital, capital allowance. The capital allowance will be computed on the tax written down value. It means as at the date the asset was transferred, it is the tax written down value that we will take into the books. It also means that this asset will have enjoyed capital allowance before now. So the tax written down value, which in FA is called net book value, it's what we are going to compute our capital allowance on. What that means is, okay, it therefore means the asset will not be entitled to initial allowance that is granted to new assets in the first year they are put to use. No initial allowance here, so it just be annual allowance on the TWDV. On the TWDV. So that is it about how the capital allowance will be treated in the case of an estate where the asset is disposed. Maybe at a particular time the asset is disposed. We have what we call balancing adjustment. We will have to compute a balancing adjustment, and balancing adjustment could either be balancing charge or balancing allowance. So balancing adjustment could either be any of these two. All right, balancing charge I have balancing charge here, balancing charge or balancing allowance. What are all this? We'll get to know when we get to capital allowance, but what it means here now is where the sales proceed is higher than the TWDV, we have a balancing charge, what we can refer to as profit on sale of fixed asset. Right? And where the opposite is the case, it is a balancing allowance. Here we are saying that where the balancing allowance is restricted to the total allowance granted, the total capital allowance that asset have enjoyed to date. Are you there? So what it means is if the balancing charge, okay, let me give a small illustration here. The sales proceed SP for an asset is maybe 150,000 naira. Okay, are you there? And the TWDV as at the time of disposal, as at the date of disposal, is 100,000 naira. All right. It therefore means my balancing charge, because the sales proceed is more than the TWDV, my balancing charge is what? Is 50,000. All right. What we are saying here that this 50,000 here should not be more than, is restricted to the total capital allowance this asset have enjoyed. Assuming this asset before now has enjoyed capital allowance of 40,000, it means my balancing charge for the purpose of tax is 40,000. Did you get that? Okay, so person liable. Who are the persons that are liable to taxation under this aspect, estate trust and settlement? Who are the persons liable? The beneficiaries, of course, including the annuitants, the executor or trustees, beneficiary, the infant that is being named as beneficiary, are all entitled, liable to tax. They are taxed as individuals. They are taxed as individuals. Here, personal income tax will come to effect. Personal Income Tax Act of 2011 will come to play. All right? They will be taxed in line with Personal Income Tax Act of 2011. Okay? So, let's look at the format. Here we have the format for taxation of these persons. First, you bring in the interest, the rent, the dividend, taxable profits, and deduct the rest of that. Then you understand this, because we're going to have a question and answer session where questions will come up on this topic and will be dealt with using this format. But this is the format. This is the format. So you look at this place, you say deduct authorized payments. Here, those persons, annuity, legacy, residual legatee here, this is legatee, residual legatee, remember, trustees remuneration is entitled to remuneration, this is it here. And then you have the computed income. You have the computed income here. You have the computed income. From the computed income, you less discretionary payments, less discretionary. Let's look at taxation of investment income. Taxation of investment income. Here we are looking at some income that we regard as frank investment income. Right? Frank investment income. Frank investment income are those income that have suffered tax at source. They have suffered tax at source. Take for example, an example of frank investment income is usually your dividend. If you pick up a dividend warrant, it is usually less withholding tax. Your dividend and interest, even your interest from your bank, it's always less withholding tax. So because they have suffered tax at source, we call them frank investment income. So it will not be proper for you to tax them. Don't forget their income, even though they are on earned income. So you bring them in the computation of tax, personal income tax. Okay, taxation in the hands of individual. Be it an employee or sole trader, you bring them in. But because they have been taxed before now, you will not tax them the second time. That will amount to double taxation. So they are called frank investment income. So what do you do? What do you do? So the withholding tax that was deducted at source is considered as final taxation. It's considered as final taxation. So how do you treat that? How do you treat that? How do you treat that? To treat that, you apply what is called the top slide. The top slice. Top slice. That is to say, the amount that was deducted as tax will be slide off from your tax computation. Will be slide off from the tax computation. That portion will not be part of the tax. That is, after computing your tax, after the tax computation, using the tax table of rates, you will slice off that amount that was deducted as frank investment income, and what is left will now be the tax that is payable. Are you there? Okay.